Bringing Alan Nuckman, he's the chief market strategist at bullseyeoption.com and a general optimist. So give it to us, Alan. We could use it this morning.
Well, certainly, it's not as important, sometimes what the market does, but what it doesn't do. We were down 1% on Friday. We're positive just a minute ago here this morning. So you look at that price reaction, and it is somewhat muted. We're hanging around this 3,900 level in the S&P. Volatility is opportunity is something I'm going to always say. But if you want to get into the weeds on what went wrong with this bank, it cost 25 basis points to hedge your portfolio. Why weren't they hedged properly? That didn't seem like a very intelligent way to run a bank. The velocity of money is really what this is all about, is the ability of people to get out, big money very quickly. And for some reason, they had to sell their long-term bonds and, at a big loss. That's not part of the plan if you're running a bank.
Alan, when you look at regional banks getting killed the way they are, I mean, this is really kind of like the lifeblood of the economy. This is where people go to get, home loans. It's where businesses go to put their money to pay employees. You disagree?
Okay, I'm going to cut you off right here because
I willingly stop.
2.7% of the SVB, depositors were less than $250,000. These are not mom and pop, okay? This is not the guy that runs the Ace Hardware in DeKalb, Illinois.
Of course.
Right?
I'm talking more like First Republic Bank and the other ones this morning. I'm saying the whole sector. I mean,
First Republic has a very similar, portfolio as well. But yeah, I'm not saying this is a contagion issue. I would think this is isolated, and that's what the markets are telling us right now. Yeah, those regional banks are suffering just because. But, the story was, unfortunately, people are focusing on the unrealized losses on the books.
Sure.
But these banks have zero intention of cashing out of their bonds if they don't have to. And they shouldn't have to if they're hedged properly. You talked about swaps. That's why these markets over my shoulder are here. And Mr. Duffy had a big article the other day in the Financial Times about how risk management is the new alpha for this for these years, because you have to be able to hedge your risk, and it's very simple. I don't know why they weren't.
Sure. Hey, I hear you. It does seem like the larger institutions that have more balanced books and diversification shouldn't be quite getting punished if they don't have to realize the losses, right? The concept of unrealized losses shouldn't be necessarily a time bomb in the market, but it ticked for SVB, and the knock-on effect, it seems like the market's worried others are going to do the same. I mean, until we figure that out, how do you trade and what do you do? I mean, is it crazy that we're a little changed when regional banks are down 15%? That's got to be like a record, right? A market unchanged with regionals down 15?
Money's not made or lost. I got a lot of these axioms. It's just moves, and it's moved out of those for right now. There will be some opportunities, but in the big picture, like you've just said, we are very little changed with this, major event happening. You got to continue to look at the broad market, and hanging around this 3,900, 4,000 level, pivoting around that is still very, very, very important. The dollar is sliding. That is helpful for some of these commodities assets, and we're going to talk about gold here this morning. Gold was only up $14 last week, but today is getting a nice bid as we try and sort out what the Fed's going to do and where the dollar is going to go from here.
Yeah, so to that point, you're not trading, you're not buying stocks this morning. You are buying gold though, right? That's what you're looking at for us.
Yeah, I really like the gold sector here for the last couple of weeks, and I think GDX is a good way to play it. It's the gold miners, and it's a diversified basket of it. Obviously, you're going to have the Barrick Gold and the big boys in here. But if you look at it, regardless of what's happening around us and what's happening in gold, this is a ETF that had been trading sideways between 22 and 32 for 10 months. All right, 27 is the midpoint of that range. It also happens to be the 200-day moving average. So it's a super support point to lean on. I've seen some leverage buying in here since October, so some smart money has been in this position. This is 25% off in the last 52 weeks, and it's also 40% off the 2020 top. So from a risk-reward standpoint, I think this is a great level to be looking at GDX as opposed to individual companies here. I just looked at this basket as I saw as a better opportunity, because you look at the two top gold mining companies, and they really represent like 20-some% of this ETF.
Gold's up 2.5%. Hey, the crypto people watching, Alan, would go, hey, Mr. Nutman, are you not aware Bitcoin's up 16% now? How come you don't buy the blockchain ETF instead of the gold ETF?
Okay, again, with the Bitcoin, the problem's not the Bitcoin itself, and I have no problem trading Bitcoin or Bitcoin futures. But the problem is, as we've seen with the holders of the Bitcoin and their financials and how they hedge and how people want their money, and the velocity of when they want money can cause these unfortunate situations for everybody. That's not because of the price of Bitcoin. So let's get back to gold. As the dollar continues to go down, that's the larger overall trend. We've had a baby bounce in the dollar, and so now let's see if it can make a test on those recent lows. That's going to be very helpful to gold. Gold can break out above the 1900 level. If you adjust the price of gold for inflation, the high that we saw, I think in 1980, was about $850, $900. If you adjust that for inflation, gold has to get to 3,600 to make all-time highs. So we're sitting about half of the all-time highs if you adjust for inflation. So the way to play here is a June 25 call. We're trading about 29 in GDX right now, so it's $4 in the money. It's trading for about 5. It's got an 80 delta, meaning it's going to act like the underlying, and it's got more than 90 days, more than 3 months for things to happen. There's a big gap up above at 34 in this, and if we just get to 34, this option gains 100%.
All right. Bullish gold, that is working today. Better than stocks. Thanks, Alan. Always a pleasure to have you, sir. Yeah, well, go ahead real quick.
All right, one thing more is just, you want to throw this in, the PE of the GDX is about 16, so it is a value as well.
All right, thank you, sir. Alan's Chief Market Strategist at BullseyeOption.com with the bullish trade in GDX. All right, getting away from some of the bank fallout for a moment. We'll be joined coming back with the CEO of International Workplace Group. And of course, right now, ahead of a very data-intensive week, one in which also includes the president speaking on the fallout of the bank collapse. We are thinking about the state of the economy. International Workplace Group is right in the middle of the hybrid post-COVID world. We'll talk about the overall employment situation and the effects of what's happening here in tech changing that. So stick around. We're going to get away from some of the bank talk for a moment.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right